Hey guys, welcome back to Sky Talks Trading. And I'm so happy that you're here because today we are talking more about dividend investing and we're going to get real practical about it. Last time we talked about the pros and cons of dividend investing. Spoiler alert, there were more pros than cons, but in case you want to watch the whole video, I'll leave it down below in the description. And today I'm going to be sharing with you a number of dividend companies that you can invest in, pretty safely for the rest of 2018 and going on into 2019. Bearing in mind I'm not a financial advisor, put that on like a little post-it in your workplace. Just, Sky is not a financial advisor. Please don't sue her. Okay? Great. The first stock we're going to talk about is American Express Company. The ticker for that is AXP. So these guys have a yield of 1.4%. It's a credit card company, in case you don't know. 1.4%, it's definitely not the most generous of dividend stocks, and we're going to be discussing a lot more generous yields in this video. That being said, if you're looking for safety, it's one of the safest places to earn passive income. So yeah, we're getting the low-hanging fruit out of the way. First, American Express is a well-known established credit provider and financial institution. This is definitely a business that it's not going to fade into obscurity, irrespective of economic conditions. As well as that, AXP caters to an affluent client base relative to its competitors. Secondly, AXP has significant international expansion opportunities. While it's true that American Express enjoys acceptance in over 130 countries, which is significantly below MasterCard, which has 210 countries, and MasterCard isn't the number one credit card, Visa is. So this might seem like a disadvantage, but this allows AXP to steal market share. And based on its resurgent revenue stream, the company is on the right track. Next, United Health Group Incorporated. Again, a 1.4% yield. There's a lot of people that maybe aren't the biggest fan of United Health Group at this specific juncture. By their very nature, insurance providers don't offer the most upside potential in the markets. So United Health Group is an American for-profit managed healthcare company based in Minnesota. But yeah, UNH stock has already done very well, gaining over 20% year to date. That said, health insurance is and will continue to be a massively lucrative market. It might be for cynical reasons. They feature consistently strong revenue growth, and this year will be no different. When it comes to yield, again, it's not the most lavish among dividend stocks to buy, but the company's very predictable free cash flow and overall industry provide significant confidence for prospective investors. Next, a fun one, Disney. Who doesn't love Disney? I actually am not a fan of Disney movies. Everyone thinks I'm crazy, but just not a fan. 1.5% yield. It's not every day that you celebrate professional failure, but for Disney, Wall Street apparently sees the silver lining after the iconic entertainment firm lost a bidding war to their longtime rival Comcast. At stake was British television company Sky. So, on the surface, you could understand the near desperation with which the two media giants fought. You've got Sky, which opens the door to the lucrative European TV market, and then you've got Comcast. Comcast in particular lost out to Disney over another protracted battle for 21st Century Fox. But, Comcast wasn't going to be defeated. It wasn't leaving the battlefield empty-handed. Shareholders, though, had a differing opinion. This is a huge, expensive bet that Comcast can turn itself around due to Sky. Subsequently, CMCSA dropped 6% on the announcement, while DIS stock gained slightly over 2%. And the cool part for Disney shareholders is that they know management has free rein to expand without an excessively onerous weight. That's not to say that Sky doesn't definitely offer benefits, but they also brought with them traditional TV baggage. Next, United Technologies Corporation. Getting slightly higher now with the yield. We got 2.3% dividend yield. It's a safe, predictable route to both upside gains and passive income. In the markets, UTX would fall under many conservative analysis bag of stocks to buy. Primarily, United Technology owns the Pratt & Whitney division that powers our most advanced warcraft. For those who love safe dividend stocks, this is a great offer. The company has excellent financials, which includes steadily rising revenues and strong earnings. And as well, you gotta love the predictability of United Technologies' cash flow. Next, we have Walmart. We don't have Walmart here in Ireland, just to let you know. I feel like I'm missing out. Dividend yield is 2.2%. It's a pretty recent thing, actually, that analysts have considered retail plays as stocks to buy. And even then, they apply significant caution into the names that they pick, thanks to the emergence of e-commerce. And of course, by e-commerce, we mean Amazon. Actual physical brick-and-mortar stores have struggled for traction and relevancy. Having said that, Walmart should emerge not only unscathed, but vastly improved. Management looked at Amazon's success and began shoring up their own e-commerce channels. Despite being a retail fixture for decades, Walmart is proving to be pretty technologically savvy. A perfect example of this is that management is turning to the blockchain to help contain food poisoning. Walmart also levers the substantial advantage of having a physical presence. Let's face it, no matter how great online shopping is, there's always going to be people that they want to go into a physical store and get that instant satisfaction. Plus, they sell everything, and some stores are open 24 hours. Next, CocaCola European partners. When it comes to dividend yield, we're talking 2.6%. Alright, so, on the real, they've had a rough time in the markets, largely due to changing consumer habits. Basically, Americans, especially younger Americans, are getting healthier habits. We should be happy about that, though. They're getting into their juices and their smoothies. It's trendy to be healthy, basically. So yeah, when I'm talking about the rough year, I'm talking about Coca-Cola, which is KO, the ticker KO. Right now, we're talking about Coca-Cola European partners. Overall, I see Coca-Cola making the changes it needs to stay relevant in this ultra-competitive sector. However, it's particularly intriguing with Coca-Cola European partners. CCEP has gone against the domestic grain, shooting up over 14% year to date. Coca-Cola European bottler and distributor also pays out a fairly generous 2.6 dividend yield. It's enjoyed a great year so far, and they're going to be continuing to move further down the road. Maybe Americans are getting more healthy, but Europeans aren't. Yeah, basically, it has a fundamental stability to keep its attractive yield intact. Next, JM Smucker Company. They make fruit spreads and ice cream toppings, beverages, shortening, peanut butter, oils, and other yummy products. They have a 3% yield. They haven't enjoyed a great start to the year earlier on. They had shares down nearly 9%. As well as that, the company's last 5 quarters have produced mixed earning results. However, the downturn is an opportunity to load up on a solid income-generating firm. A big point to consider is its industry. As a popular food and beverage provider, the company's products will never go out of style. That provides a measure of reassurance, especially if the markets hit unforeseen headwinds. People are always going to want to buy fruit spreads. Next, we have IBM. They have a very nice 5.2% dividend yield. And it's one that has tried investors' patience. Although there's no doubt that it has earned a powerful reputation in the tech sector, many people regard IBM as a legacy company. But that doesn't mean that this old dog is forever doomed to be irrelevant. Remember what I said earlier about Walmart using the blockchain to eliminate food poisoning cases? Well, it just so turns out that the provider of the blockchain platform is, in fact, IBM. Plus, IBM has the foundational strength to support its 5.21% dividend yield. It has consistently positive earnings, as well as reliable FCF. It's sitting on over $3.4 billion in cash. Finally, we're going to talk about AT&T, which has a yield of 6.6%. Definitely a favorite among dividend stocks. This telecom giant currently offers nearly a 7% yield, which is better actually than some blue chips equity market returns. You know, especially with the 5G rollout, I don't think you can afford to ignore this stock. They are really taking extra time to do things right, where they will roll out 5G using only standard equipment. Over the long run, the smart money favors the T stock over something like Verizon Communications. So guys, I hope you enjoyed this video. Let me know if you're already invested in some of these, which ones you plan to get your nice monthly dividends from. And yeah, happy investing, guys. Talk soon.